All right, welcome back to the next trade plan. This will be the second trade plan we're doing. So just a reminder, we're doing an exercise where we're going to plan and execute 30 trades while knowing ahead of time exactly where we're going to enter, how much we're going to risk, how much we're going to stop, where we're going to exit, and where we're going to manage. And I encourage everybody to use me as a guideline and play along. A trading plan consists of some sort of a method. You'll have your own method. I'll try and describe mine a little bit here and there. Entry, stop, exit, your position sizing, and then just documentation. And so, I'm going to babble quite a bit, but I'm also going to demonstrate while I do this. And just keep in mind that the purpose of this exercise is to change how you experience markets, to learn what consistency and discipline is, not just read about it, right? You can read about it all day long and it won't do you any good. This is getting it in your bones, in your own personal insight. And that's why, I'm big on practices because it does no good just to say something. It does no good to listen. I mean, it makes you aware. I mean, it's a start. It does no good to read a book. It's just a start. You have to be doing. And so I appreciate the feedback also on the last one, the kind comments. And we'll just keep doing this. And whatever time I have, I'll um, I'll talk a little bit about market structure and swings. I'm a swing trader. I'll talk a little bit about entries and position sizing. So we'll try to include a little lesson now and then as we go. As you're making your trade plan, just keep it as simple as possible. It doesn't need to be complicated. The more complicated you make it, the more you're not going to want to do it. And we already have some natural resistance to doing this kind of thing, to being this accountable. So, a bad trade plan is better than no trade plan at all. Why? Because if you're just doing things randomly with your entries and your stops and how you're getting in and you heard it on the news, whatever, it's going to be very difficult to learn. If you're making a plan, even though it's not working out for you, you have a basis to learn and see what needs correction and incrementally correct. It's very much scientific method. So just a reminder, these posts that I'm doing, it's not about the method. It's not about the setup. It's not about being right. It's not about winning or losing, right? It's not about what the S&P is doing or if Mercury's in retrograde. It's not about anything other than the purpose of this exercise is to change how you experience trading, to begin to learn discipline and consistency and begin to wear away some of the normal fear-based ways we experience and distort trading. So I'll have a lot to say about that as we go. This is about making a plan and then doing your plan as you say you're going to do it, whether it's a good plan or not. And you will learn as you go if you adapt this kind of a practice. Whatever method you're doing, I suggest you strive to make it as simple and objective as possible. Don't leave it abstract, right? You want to know exactly what gets you in and what gets you out. All right, so let's just do some of this. We're going to line up Lennar. We already got Adobe as one of our orders sitting out here. Yeah, so it's still waiting. And like I said, I'm a swing trader. All I'm doing is taking a swing and then see this tool here is just cutting it up in quarters to help me be very objective with my entries, my stops, and my management. That's it. I'm just swing trading. So I'm trading this swing to continue. And what I'm looking for is for this swing to pull back and continue, right? That's the structure of it. So there'll be time as we move on to talk about these things. So let's go ahead and make our plan. Now I'll be doing one of two setups, which we talked about in Adobe, and I'll be using uh, two different entry types. One type is more of a confirmation type of entry. So let me just describe that. Adobe was just placing a limit order down here, a resting limit order, to take us in or stop us out or whatever. This method, it's the same setups, but it uses a little bit more of a confirmation, meaning the market pulls back and I'm going to require it to start up a little bit. How much am I going to require it to start up? Well, I'm going to want it to hit the 50% line. That's what that is. So there's nothing special about this tool. There's no secret fib numbers or anything. There's nothing special about the 25% or 50. It just makes it simple. If you want to use a fib number for this, you can. Doesn't matter. Or a secret number, doesn't matter. And the secret is if you pick something and do it consistently, you're generally going to do all right. And there's no magic in the lines here. All right, so let's go about this, and I'll explain this. Right, so I'll try and give a little bit of explanation about what I'm doing as I go, but just use your method and know how you're going to enter. I know how I'm going to enter. What I'm going to do is use this 50 lines, 50% of the reaction leg, to let the market stop me in, right? So if the market comes up and hits this, it's going to take me in. I'm telling the market it needs to come up and take me in for me to enter the trade. This is a confirmation type of method. If, so here's the basic rules of it, right? If it hits that 50 line, I'm in. If it never hits the 50 line and hits the low, the trade is canceled. Once it hits the 50 line, I'm in, and then I am managing it according to my management. And this is just a little risk reward tool. I took a fib retracement tool and I set it up like this. And it's just a little risk reward tool to, give us a reference point. So let's look at what my method says for management. And management is all about, once you're in the trade, if it starts making profits, you want to give it room to run, but you also want to protect those profits. When I originally started doing these setups, I just said, you know what, I'll get to BE at 2R, and it'll either take me out of BE or I'll exit at 5, one of the two. That's nice and simple. Nothing wrong with that. There's nothing special here. Come up with something and be consistent. If you're not sure, you can put a moving average on this and say, all right, close outside the moving average and I'm out, that kind of thing. So if it takes me in and hits 2 to 1, all right, which is going to be the high, then I'm going to move to break even. I'm going to move my stop from risking 1 to no risk at all, right? I'm going to move to break even. That means if the trade backs up and comes back to that line, I'm out. No harm, no foul. And then after I get to break even, I'm going to trail my profits by 2R. So remember, this is one risk unit, and this is 2, 3, 4, 5. So that means once I hit, here, let's just go ahead and make this bar the same size as 2R. So once I hit 3 to 1, I'm now moving my stop to a profit of 1R. Once I hit 4 to 1, my stop now moves to 2R. So if it bounces back, I'm out at 2R. Once I hit 5, my stop moves to 3R, which will be the high basically. And then I'll exit at 6, period. There's probably better ways to do this, But again, the secret's in the consistency, not spending all your time. It's principle based, but pick something and be very consistent with it. All right, so let's put our orders in. We know exactly where we're going to enter. See this? 149.87. That's what that line says, 149.87. And I'm going to just get this ready. I'm going to know what I'm going to do ahead of time, 149.87. And just as a practical matter, I'm trying to include a lot of things, especially for new traders. I'm going to use a buy, stop, limit order. Now, previously with the Adobe trade, I just used a limit order. So I'm going to let the market stop me in. And I want it to be a buy, stop, limit order because if it gaps up here, I don't want to be entered up here. I want to be entered on this line, period. I can leave this order in. If it gaps above the line, I leave the order in until the high is done. But I'll leave the order in to see if I get filled. If I don't get filled, it cancels the trade. Sometimes it just gaps and takes off. But you don't want it to gap up here and fill you up here. And you're going to have to check with your own broker because some brokers, you put this order in, it's exactly what it's going to do. So check with your own broker about this kind of thing. So just practical matters here, we always have to consider. And my rule for if things ever go sideways for you and something really unexpected happens, and if you're a trader, it's going to happen, right? You're going to have some gap this way, you're going to put the wrong order in, or you're going to add an extra zero. Immediately flatten. Don't try to work the order because you're already off balance. You're just going to mess things up more. Just flatten it. Don't spend any more energy on it. Move on. It's going to happen. All right. So whenever I enter here, I'm going to put my stop 25% down, 146.80, like so. And then I need to calculate shares. We'll use the tool to calculate shares. But you should still know how to do it, right? If I'm going to basically subtract 149.87, 146.80. That'll tell me how many points I'm risking. And that'll go into my $500, which is a 0.5%. And while I'm here, there's always so many points I want to bring up. Why am I not concerned if I lose all my trades in a row, 30 trades in a row? You know why I'm not concerned? Because I planned for it ahead of time. If I get 30 stops in a row in this exercise, I've planned for it ahead of time right here. So think about it. We're using a 100K account. I'm going a 0.5%. That's $500 per trade. If I lose 30 times 500, that's 15K, which is 15% of my account. Right? So if I get 30 stops, I'm going to be down 15%, and that's acceptable for me. Right? To lose 30, I'm going to be down 15%. If your risk profile is more like, no way, make it 7, that's easy. You do the calculation, and then this goes from a half to, whatever's appropriate, a quarter. But mostly, you should be simming this if you're getting started. But that's why I'm not worried, right? I've planned for it. If you oversize yourself thinking, oh my God, I'm going to get this one trade, you're going to be sweating every inch of it. All right, so I just wanted to mention that. So let's do the shares. Now we can do the risk reward, but I have a particular routine I do, and I showed you I use a spreadsheet, just a spreadsheet I made, where I enter everything. This is part of the documentation for me, and it's good for you to develop a routine. Okay, develop your own routine. That way you just keep doing things the same way. There's plenty of free journaling softwares out there that you can do the same thing with. So all I'm going to do, I already started it, just to save time. Enter the date, the stock, how long. I'm going to put my entry in. I'm going to put my stop in. It's calculating the shares for me automatically. And if I put 5 to 1, if I put 6 to 1 in, it's going to calculate my target for me, 168.29. It's also going to tell me how much of this portfolio, right, how much of my 100K it's going to take to trade that. All right, so I have my shares. Now I can put them in here. It's going to be 163 shares, and I know my target somewhere around here. If I get this thing cooking. All right, let's work on this. So I'm going to put my target in 168.29. And you can add any other notes that you wish to add to this, any other personal notes, what you're seeing and thinking. Personally, I don't think this trade's going to work. The last thing I want to do is buy a housing stock up here after it's been running. I don't think it's going to work. But that's the point of the plan, right? It's not about what you think. Do what you say you're going to do. You'll realize what you think is generally has nothing to do with actual reality and that you can't predict the market in the first place. Say, I don't think this thing's I don't really want it to take me in, but I'm going to make the plan. I'm going to do the trade anyways. That's part of the discipline. All right, so I know how I'm going to enter. So let's go ahead and put our orders in. Now, TradingView has this nifty risk reward tool. All right, so I can put this risk reward tool like so. That's going to be my entry. It's a great tool because you can set it up with how much you want to risk. And right here, this little number here is going to be my risk reward. It's going to be right around there, right? So, a few of the pixels might be off. We'll tighten up the order. And then it lets you just, hey, make a bracket order out of this. It's called a bracket order, meaning as soon as my entries hit, it's going to throw a stop in there for me. So 187, all right, that was pretty close. I have it preset to $500 risk, which is a 0.5%. And it's telling me how many units I need to trade. So let's check and make sure our stop is where it needs to be here. 146 should be 80. And our target's going to be 168.29. And we just kind of check over things. And I don't know why it's got my risk at 516, but let's just fix that up because it's messing my shares up. All right, so the shares are going to be 162.86, which is what we had on the sheet, rounded out to 163. And that's it. Just double check everything. I know it gets a little tedious, but you'll get used to it. And we'll open up this trade so we see we have Adobe. So it looks good. Let's place our order. Let's set this for a week, so time and force. And order sent, and it looks like we're good to go. Let's close that up. And there's no moving the order after this, okay? That's it. We have a limit to take us in. We have a stop. There's no moving. If there's a mistake, you bang out, like I said. There's no watching it every 5 seconds during the day. The order's placed ahead of time. And so let's wrap this up.